Ever wondered, how do changing mortgage rates affect you? Well, let's dive right in. Mortgage rates, in a nutshell, are a critical part of buying a home. They're the interest you pay over time to borrow money from a lender for your home. Now, these aren't just plucked out of thin air. They're determined by a variety of factors, including the state of the economy, the lender's business strategy, and even global events. Think of it like the price tag on your dream home. It's not just about the bricks and mortar, but the neighborhood, the market demand, and so much more. And just like that price tag, mortgage rates aren't static. They change, they fluctuate, and that's where it gets interesting. Because those changes, small as they may seem, can have a big impact on your pocket. Now that you know what mortgage rates are, let's delve into how their fluctuations impact you directly. Mortgage rates don't stay the same, they fluctuate. But why? You might wonder. Well, a number of factors come into play here, and we're going to break it down for you. First off, let's tackle economic conditions. You see, the overall health of the economy has a direct impact on mortgage rates. When the economy is booming, people are more likely to borrow money, which can lead to higher mortgage rates. Conversely, during a downturn, rates often drop to stimulate borrowing and economic activity. Next up, inflation. This is the rate at which the general level of prices for goods and services is rising. When inflation is high, mortgage rates usually follow suit. Why? Because lenders need to make sure they're making a profit above and beyond the rate of inflation. Now let's talk about housing market conditions. If there's a high demand for homes, mortgage rates can rise as lenders know people are willing to pay more. However, if demand is low, rates can drop to attract more borrowers. Lastly, it's important to understand that these fluctuations can be a double-edged sword. On one hand, lower rates could mean smaller monthly payments and potentially saving thousands over the life of your loan. On the other hand, if rates rise, your monthly payment could increase significantly. So, changing mortgage rates can make a big difference in your mortgage payments. But how exactly does this work? Stay tuned to find out. How do these changing rates translate into dollars and cents in your mortgage payments? Let's dive into the nitty-gritty of how this process unfolds. Imagine you're all set to buy your dream home. You've secured a mortgage at an interest rate of 4% for a 30-year term. Your monthly payment, which includes principal and interest, would be a set amount. But what happens when the rates fluctuate? If the mortgage rate climbs to 5%, your monthly payments would increase. On a $200,000 loan, the jump from 4 to 5% could lead to an increase of about $120 in your monthly payment. That's an extra $1,440 annually, which can add up to a significant sum over the life of the loan. On the flip side, if the mortgage rates dip to 3%, your payments would decrease. Using the same $200,000 loan example, a 1% drop could save you about $240 on your monthly payment. That's an annual saving of nearly $3,000, which over 30 years can be a substantial amount. So, whether you're a first-time buyer or an experienced homeowner, it's crucial to keep an eye on changing mortgage rates. They can directly affect your monthly payments and, by extension, your overall financial health. As you can see, even a small change in the mortgage rate can have a significant impact on your payments. So, what's the bottom line on how changing mortgage rates affect you? Let's recap. The world of mortgage rates can seem like a roller coaster ride, but it's one that potential or current homeowners can't afford to ignore. These rates fluctuate, sometimes unpredictably based on a myriad of factors such as economic conditions and policy changes. The impact of these changes on your mortgage payments can be significant. A rise in rates could mean higher monthly payments, while a drop could mean savings. The key here is to stay informed. Keep a keen eye on the market, follow financial news, or even consider consulting with a mortgage advisor. Knowledge is power, especially when it comes to navigating the ever-changing landscape of mortgage rates. Remember, being informed about mortgage rates and their fluctuations can help you make wise decisions about your mortgage and potentially save you a lot of money in the long run.